All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time, leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to like and bookmark this channel right now. Today, I'm digging deep into the Double Play archives, and I've finished editing a video that I shot way back in May of 2020 during the pandemic, and just now getting around to getting it out there. So, subject of this video is buy term and invest the difference. And this is something, it's pretty important. You've probably heard this a lot, and I probably should have gotten this video out a long time ago. But the goal of this video is to simply show you that the idea of buying a term insurance policy and investing the difference that you would have saved putting into a permanent policy does not make the best financial sense. The double play, in fact, makes much more financial sense. So if you're interested in learning why, stick around after the intro and I will break it all down for you. Alright, so today we're going to be talking about buy term and invest the difference. If you've ever asked someone for their opinion on permanent life insurance, you've no doubt heard the expression buy term and invest the difference. A lot of life insurance naysayers will always use that as an example. And it was popularized by Dave Ramsey and Susie Orman, who use that on their radio shows as well. But what I'd like to ask you is, where's the proof? Has anyone ever shown you proof that buying term and investing the difference is better than buying a permanent life insurance policy? The implicit assumption in buy term and invest the difference is that permanent life insurance is high fee, high commission, and the agents are only pushing it for those high commissions, that it's not a good value for your money. But has anybody ever shown you a spreadsheet to show that? Well, that's what we're going to talk about today. My goal with this video today is to convincingly show you that if your goal is to use the difference to save up for or replace income that would be lost if someone were to lose their job, that you'd be better off doing that with a permanent life insurance policy than you would by buying term and investing the difference. Now we're going to get pretty technical into the fundamentals of life insurance, so if you're unclear about how life insurance works or what the cash value of a life insurance policy represents, how you can borrow against the life insurance policy, please go down to the description box right now. There's a link to my ebook, Life Insurance 101. It's available on my website as a free download. There's also another video on my YouTube channel for Life Insurance 101. You can also pause this video and go out and watch that one and then come back to it as well. So the way we're going to attack this today is I'm going to break it down into four main steps. First off, I want to cover the premise of buying term and investing the difference. What exactly does it mean? What is it trying to accomplish? Then we're going to focus back on life insurance and look at the anatomy of a permanent life insurance policy, what I call Life Insurance 101. The third thing we're going to look at is if we presume that the difference being invested is going to ultimately be used for generating retirement income, then I want to take a look at how much income a permanent life insurance policy can generate versus how much income you can get from the difference. And the last thing we're going to cover is indexed universal life and why I believe that the advantage goes to an indexed universal life to both provide the death benefit protection that you need as you're saving towards retirement and for maximizing the amount of retirement income that you can get from your savings. So let's talk about buying term and investing the difference. What exactly does that mean? And the idea is that a person is going to buy a life insurance policy in order to replace the income that or savings potential that's lost if one or the other spouse is not working. If you can imagine a young couple, newly married, perhaps in their 20s, and that couple, starts up a family, buys a house, and starts to save for their eventual retirement. We go through life and we accumulate assets with the goal of one day starting to take from those assets and we need to have enough there to replace the income from our working years. So the purpose of life insurance is if something were to happen to the working spouse or if both spouses work, just to be able to replace the loss, to basically pre-complete the savings plan. I guess that's the best way to look at it. It's just a mechanism for pre-completing the savings plan. Life insurance naysayers argue that permanent life insurance is high fee and a very inefficient vehicle for saving for retirement income. They believe that your money would be better off in the market and then using cheaper term insurance to make up that shortfall if something were to happen, basically to be the pre-completion for your savings. So they would argue that you should take whatever the premium would have been on a high-cost permanent life insurance policy and figure out what a term policy costs with the death benefit that you need and take that savings and invest it. Well, I'm going to make the case that you'd be better off putting your money into a permanent life insurance policy, and it'll provide the death benefit protection that you need, as well as providing even more retirement income than you could have received had you bought term and invested the difference. So let's take a look at what buying term and investing the difference looks like. So in this example, I'm actually giving an unfair advantage to buying term and investing the difference. We don't know how old the couple is, whether or not they use tobacco products, if they've got health issues. So this graph is showing a 30-year-old with $1 million term life insurance policy. And again, since the term insurance is free, I'm just assuming that it's going to run forever. And I've got the $1 million horizontal line running all the way across this. The blue line, on the other hand, represents the difference. That's the client taking that savings from the free term insurance policy and they're putting it into the market at 6% net rate of return. And you can see that the growth curve runs into the $1 million around the time that the couple reaches retirement age. And I designed it that way on purpose just to show that the $1 million is their retirement nest egg. So if something were to happen to either one of them earlier in life, they've got that death benefit protection to basically pre-complete their retirement savings plan. So anywhere along this graph, the difference between the death benefit, the orange line, and the cash value, the blue line, represents the amount of risk being taken up by the insurance company, by that term policy. So early in the policy where I've got the bracket on the left side, you can see that if the insured were to die at that point in time, they've really got zero savings at the very beginning, and the term life insurance policy would pay out the $1 million and the remaining spouse would have their plan pre-completed. Now the question becomes is how long should that term be? Should it be for 10 years, 20 years, 30 years? Clearly in this example there's a need for at least 35 years of life insurance, because it'll take 35 years at least before that blue cash value line reaches the $1 million. So if we assume that the couple's young, they bought a house, they need to maybe pay off the mortgage if something were to happen to that, they're raising kids, they want to make sure that if something happens, their kids can get a college education. By the time they reach 65, the house should be paid off, the kids will be through college and off on their own, and the need for life insurance will be down by that point, and hopefully the savings is back up to the point where it will provide the retirement income that they'll need. So around the time that the insured is about 52 years old here, you can see that their savings has increased to the point where they've got roughly about $500,000 worth of savings. So now they really only need about $500,000 of additional death benefit protection because they've already saved up half of it. I mean, that's the whole point of buying term and investing. The difference is that difference will eventually replace the need for having a life insurance policy. So this person could handle this need by perhaps having a $500,000 policy for 30 years and then layering on a 20-year term for another $500,000. So that would give them the total death benefit that they need without overpaying for insurance. Because here, if they bought $1 million of term life insurance for 30 years, that would actually be overkill. They'd have their savings, and then they'd have the death benefit on top of that. So if they really wanted to keep the expenses to a minimum, they could break this down into a 10, a 20, and a 30-year policy that slowly but surely close that gap and only insure the extra that they need there. So, or they could just keep the entire $1 million term policy for 30 years and pay it and have that as a surplus. So what are some of the assumptions that go into buying term and investing the difference? Typically, it assumes that the insured is young, because if you're going to be replacing $1 million or $2 million, it takes time for money to grow and compound and reach that target. So if you're in your 20s or even maybe early 30s, it's possible to design a savings plan that can get you from point A to $1 million or $2 million in 30 or 40 years. But if you're in your 40s or 50s, you've got a lot less time to play with. And saving up $1 million requires a much more significant investment in savings. So the general assumption for buying term and investing the difference is that the couple is young. It also assumes that there's no death benefit need in the future. And that's debatable. I mean, lives change, people change, things happen. We don't know that for certain. But one thing that is certain is that during that 30 years that you have that term policy, assuming it's a 30-year policy, if something were to happen to you health-wise and you become uninsurable, you may not be able to get the death benefit protection that you might want. And it also assumes that the investment account is going to do better than the cash value of the life insurance policy. Now, as a general rule, the life insurance companies invest the cash value in safe, secure debt instruments. They're not out to win a race, they're just there to provide a death benefit protection. So they invest their assets in nice, safe, secure instruments that they don't have to worry about the money being there if the market were to collapse. If you invest your money on your own, you take market risk into account. So at any given time, the markets could be up or the markets could be down, but we're assuming that, at least in the buy term invest the difference scenario, there's an implicit assumption that investing the difference is going to allow you to achieve a higher rate of growth. But as I always say, it's not the assets that matter, it's the income that those assets can provide. And that's what we're going to dive into here in a second. And lastly, the model assumes that the person actually puts the money aside into savings. And as any of us who are a little bit older know, when you're young and you buy a house, typically it's a stretch to get that first mortgage and make the payments on it. And then when you have a little extra money to spare, you have children. At least that's how it was for me. And then when you have even more money, then you have another child. And for a few years, you don't have a lot of money going into savings. So the buy term and invest the difference assumes that the person is going to actually have the dedication and discipline to take that money and set it aside. Whereas a life insurance policy is much more rigorous and you have to make those payments. All right, so now let's talk about the anatomy of a permanent life insurance policy. And I've covered this in many of the videos before, so I apologize for the people that are seeing this again. But in a permanent life insurance policy, the insurance company knows that they're going to be paying a death benefit to someone someday. And insurance companies are in the mortality risk business, so they know what the average life expectancy is for pretty much everybody. So they design a savings plan that basically has the policy owner saving up the death benefit for the insured over the insured's expected lifetime. So this chart shows a 45-year-old with $1 million permanent life insurance policy. This is an example of a minimally funded life insurance policy. So it's collecting the least amount of premium necessary to fulfill the obligations of the policy. But here you can see that of that expensive premium, I'm being sarcastic there, of that expensive premium, some portion of those premium dollars are going towards making up the shortfall between the $1 million death benefit and the cash value. So essentially the insurance company has to go out to the reinsurance market and buy a term policy on the life of the insured to cover the risk that person were to pass away. And they have to pay the death benefit. Now, it's not always done through a reinsurance contract. They could reinsure it in-house if they're large enough. But it's very easy to explain it to somebody if you think of it in terms of an insurance company going out and buying their own term policy to cover the gap between the death benefit that they've sold and the amount of cash value that the policy owner has saved up. So in this graph, you can see that the blue line, the cash value, is slowly but surely growing over time and eventually runs into the $1 million death benefit. The death benefit is the orange line at the top. And every year throughout there, as the cash value is increasing, the insurance company has to buy ever lower amounts of term insurance to offset their risk, that gap between the death benefit and the cash value. Why am I showing this to you again? Because the point I want you to understand here is the insurance company is buying term and investing the difference. This chart looks very much like the other one that I just showed you. The only difference being that the insurance company is investing its assets in very safe, secured debt instruments with a very modest rate of return, but a very low rate of risk. Whereas in the buy term and invest the difference scenario, the policy owner is doing their own savings and achieving, hopefully, a much greater level or rate of return. And then the other difference is that this savings plan goes out over the life of the insured as opposed to simply to age 65 for retirement age. So since both approaches involve buying term and investing the difference, which one is really better? The cash value of a life insurance policy is growing at a nice, safe, secured debt market rate of return, whereas the savings from investing the difference is growing at a market rate of return depending on what the couple is doing with the money. So which one is going to generate more retirement income? Well, most financial advisors use the 4% rule as a rule of thumb for determining how much income you can take from your savings without ever running out of money before you pass away. So the typical rule of thumb is, it's actually less than 4% nowadays, but I encourage you to Google the 4% rule and do your own research, and just so that you know that I'm just not making this up here on the spot. But the 4% rule, I'm actually being generous by allowing 4%. Most financial advisors won't use 4% anymore. It's a much lower number. But again, I gave away the free term insurance. I'm going to give the difference, the benefit of the doubt, and say that it can get 4% income relative to the amount of assets. So I promised that we would take a look at the numbers, so let's take a look at this table. All right, this is a spreadsheet model that I put together to model a life insurance retirement plan. And it's applicable in this case because I've already made the assumption that I'm giving away the term insurance. So even though the cost of term insurance gets much more expensive as the insured gets older, that's all right. I know that life insurance retirement plan is going to provide more income. And if I give it away, then you know that it's actually better than what I'm showing you here. What we're looking at is a simple A versus B comparison. I want to know, year by year, am I better off putting money into a life insurance policy to provide my death benefit protection, as well as a savings mechanism for generating retirement income someday? Or am I better off buying term and investing the difference and achieving a market rate of return? In the columns under the orange header is the life insurance scenario. And these numbers are literally copied and pasted from a life insurance policy illustration that I would prepare for someone. To the side of that, we've got the difference scenario. And up in the upper left corner are the user definable input parameters. So I'm trying to account for taxes and the rate of growth on the assets. And here I'm assuming a 9% rate of return. This is no fees. I am accounting for taxes, assuming that the money was taken out at tax at your ordinary income tax rates upon withdrawal. So this is a maximum overfunded life insurance policy design where the goal is to keep the death benefit to a minimum and maximize the growth of the cash value. So the death benefit is not shown on this graph, the graph is only showing the cash value of the policy. And I just want to be able to compare dollars to dollars so that you can see. And one thing to keep in mind with a maximum overfunded life insurance policy is that the death benefit is increasing. So we're starting off with as small a corridor of life insurance as we can get legally over the amount of cash value that we start with. And each year, as the new premium comes in and the cash value accumulates, that initial increment of death benefit is just simply being pushed up by the cash value that's being slid in underneath it, so to speak. Now, in the alternative scenario, if you look at the input parameters in the upper left corner, we're assuming a 9% rate of return. So in the last example, I used a 6% net rate of return. Here, I'm using a 9% rate of return, but I'm accounting for the taxes in the model. And these are all input variables that are user definable. So as we might expect, if the cash value is growing at 6% and the difference is growing at 9%, we can expect the accumulation in the alternative or difference to be greater than the accumulation in the life insurance policy. So there's really no surprises here. And my problem with all the financial gurus out there is that their analysis of this stops right here. They're looking solely at accumulation values at the time of retirement and never at the amount of income that you can generate. And I don't think that most of the gurus out there understand just how much income you can get from a permanent life insurance policy, and specifically an index universal life, which we'll get into in here in a second. But the advantage of a permanent life insurance policy is that you're borrowing against the policy's cash value. So all of the money is still in the policy and it's working while you're getting a loan from the insurance company secured by the cash value of your policy. In the description, I'll have a link to the Florida statutes that cover policy loans so that you can see how it's worded with your own eyes. But keep in mind that all 50 states in the nation have similar statutes on their books. Insurance companies are required to make loans to their policy owners secured by the cash value of those policies. And if they don't make a payment on the loan, the insurance company is to add the interest onto the loan balance, and they can take it back if and when that person dies and the death benefit is paid. They can take out what they're owed from the death benefit proceeds. So ultimately, as long as there's a 1% arbitrage between the rate of growth on the cash value and the loan rate that you're paying on the loan, the life insurance policy can typically generate about an 8% income relative to the cash value at the time of retirement. That's compared to the 4% rule for money in a traditional brokerage account. Now money that's in an IRA or a 401k hasn't been taxed yet. So when those distributions are made, it's taxed at ordinary income tax rates. So if you have $1 million, for example, well, the 4% rule would dictate that you can take out $40,000 a year. But if you're in a 25% tax bracket, you're going to net just $30,000 out of that $40,000. Now, $1 million of cash value would generate about $80,000 tax-free. So that's almost 3 times as much income from the same amount. So what you need to do is take a look back at this curve now and ask yourself, is the difference at least 2 to 3 times higher than the cash value? Because if it's not, the cash value is going to generate more income, right? So this graph is looking at the income, not the accumulation values. So what I've done here is I've converted that table of numbers that was the input for that last graph, and I just simply multiplied every year's values by 8% to show you how much income you could get at that particular age versus the 4% rule for the difference, how much income you could get from your savings invested in traditional investment assets. And you can see that from day one, the cash value, even though it got hit with much higher fees, is still capable of generating more income from day one. The person in this example could only take about $25,000 a year of income if they retired around age 67 by living off of the difference in the buy term and invest the difference scenario. whereas the income looks to be somewhere around $40,000 a year tax-free if they were to retire on a life insurance retirement plan. So now I want to change gears and talk about index universal life and why I think it's better for any application involving the double play or life insurance retirement plans, which is what we're talking about here really. If you don't understand how an index universal life policy works, I've done a couple of videos on them. In fact, the video that I released last week actually covers index universal life specifically. So I highly encourage you to go down to the description box below and click on the link for that video. I stuck it down there, and just get up to speed on how the mechanics of an index universal life policy works, so that you understand how the interest is credited and calculated. But the main point I want to make here is the interest crediting in an index universal life is able to capture some of the equity premium. And what do I mean by the equity premium? It's the difference between the equity market rate of return and the debt market rate of return. Typically, if you invest in a portfolio of stocks, you would expect to earn an equity market rate of return. Well, the goal of an index universal life is not to capture the equity market rate of return. It's simply to beat the debt market rate of return. So while they're taking the interest from the assets that make up the cash value, the safe secured debt instruments, they're taking that interest and they're going out to the options markets to basically buy as much movement in the market as they can get with the money that they have. Now, the goal is not to capture the entire equity premium. It's simply to do better than they would have received had they just simply paid the interest that they received as a dividend. So it's important to keep that in mind, because that's a common misunderstanding, because a lot of gurus will tell you that an IUL isn't a fair representation of the market because it doesn't include dividends. Well, of course it doesn't include dividends. It's the index, right? And it's beside the point. The goal is not to capture that rate of return. It's simply to beat the debt market rate of return, which is what they're investing in anyway. So it's just a hedging strategy to capture a little bit better rate of return without sacrificing the principal. Now, they're introducing volatility, which is risk, right? You could get a 0 or you could get 10, 12, 13% returns, but you're principal protected. And that's the key here. So what this allows is interest rate arbitrage. If we assume that the cash value is earning something better than the debt market rate of return, then there should be some gap or difference in the performance between the cash value of that policy and the loan rate that you're paying to borrow money in the debt markets. Debt market with a premium, right? So there should be a gap over time. It's not going to be there on a year-by-year basis, but over time, the cash value should grow at a higher rate than the loan balance that you're taking. So because you have more cash value being created, unsecured cash value being created, let's be clear, you have the opportunity to borrow more from the insurance company, knowing that the collateral to offset it will be there. So in an index universal life, you're actually able to take more retirement income than you would have been able to had the interest rates been closer. So hopefully this has all made sense to you. If you've got any questions, I recommend that you go down and just write it in the description box down below. I'll be keeping tabs on that and I'll respond as quickly as I can. If you're hungry for more information and you're not ready to speak to a life insurance agent yet, I highly recommend that you go out to Facebook and join the Double Play group. This is a group that I created, and it's made up of my clients who are utilizing the Double Play for their real estate investing, as well as many people who are not my clients, who are doing the same thing or just there to learn. But it's a forum in which you can ask questions of people who are actually utilizing this strategy, as opposed to me, who's obviously a biased agent, just trying to sell product. Go out there and talk to people who are actually doing it. And then there's also just a ton of resources available on my website. I consider my website to be a no fluff zone. So I've got tons of information, no commitments. Go there, read what you want. Most of these videos I'm also turning into blog posts at the same time, so there's a written version of most of what I've got on these videos. And the link to the website is in the description down below. Hopefully I've done a good job of convincingly showing you that a life insurance retirement plan is actually a more powerful vehicle than simply buying term and investing the difference.